going to talk about the economic crisis and so on. If I read the title, actually, of the talk, Banking, Honest Money and the Free Market, and if I gave that title to people in the street, they would say that is not possible. You cannot have the adjective honest together with banking, free markets and money. And actually, it is possible. They would think that in a moral sense that doesn't tally, but actually our speaker is going to show, I think, that honest money is as much a matter of morality than it is of economics. Our speaker is Dr. Anthony Evans, who is Professor of Economics at the École Supérieure de Commerce de Paris, and he is also the founding Senior Fellow of the Cobden Center, which is a new think tank which promotes precisely this, honest money, promotes Austrian banking, and has the name Cobden because it is also promoting free trade. So, ladies and gentlemen, I give you Dr. Anthony Evans.
Thank you. So thank you for having me today. I apologise, I've not been to any of these sessions apart from the immediate one before this, because I was supposed to be moving house this weekend. And that also explains why I'm using PowerPoint and not creating an elaborate talk that's going to go into those things. I don't even realise why I'm using PowerPoint. I've got some images that I want to show you, which kind of necessitates that. But I've just noticed that this is using Windows 7. It's not my laptop. If it explodes, it's nothing to do with me. We've said that you have to come forward so that you can see it, but I'm concerned that this is the first time I've seen this Windows 7. So we'll see if it works. If it doesn't, it's not my fault. I've called this process, so the brief was Banking, Honest Money in the Free Market, and I've given it the subtitle Prospects. I have basically two options with this talk. The first is because I don't know, I know a couple of you, but I hardly know any of you at all. So one of my options was to kind of give a big encompassing talk about what honest money is, why it might be considered to be important. What I've decided to do instead is to share with you some work that I've been doing at the moment, which gets at the issue of the prospects for honest money. So I'm almost taking a lot of the economics for granted about what honest money is. And especially given that this is the final session in this conference, I want to start thinking about the prospects and what might happen in the future. Broadly speaking, I'm an Austrian economist. I'm one of the few Austrian economists that has a faculty position in the UK. The reason why Austrian economics is important here is because it essentially provides the rationale that underpins honest money. So this is a conference of the Libertarian Alliance. I'm sure that people are hostile to state institutions generally, and that's all fair, well and good. But if you're not familiar with the Austrian economic arguments about the trade cycle, this is a good thing for you because now you have some intellectual ammunition to support these ideas. If we identify the central bank as the main source of a monetary disturbance, and increasingly this is what people are coming around to understand, this is the Austrian theory of the trade cycle, the implication of this is that we have a free market in banking. So the reason why Austrian economics is important for us all now is that this is the scientific rationale that challenges whether or not the state should be involved in controlling the monetary system. As an Austrian economist, I've been very interested in the build-up to the financial crisis, what we've been seeing now in terms of the ideas that have been making mainstream respectability. I appreciate that the font size is very small and we haven't blown this up very big. I'll make this obviously available to as many of you that if you want to email me afterwards, I can send you a copy of this. What I've got here is a couple of quotes that I noticed in the build-up to the crisis, where I started to get the impression that Austrian ideas were known on some small level. These are from The Economist. This is 2002. The Austrian cycle may become more common again if, as this survey will argue, financial liberalisation has made bubbles in credit and investment more likely. That was The Economist in 2002. In 2003, The Economist again. America displayed many of those Austrian features in the late 1990s. Faster productivity raised the natural rate of interest, but because inflation was low and because Austrian economics had long been out of fashion, the Fed failed to lift interest rates by enough. Also, The Economist in 2006, a more relevant model might be one based on the Austrian School of Economics. So there's widespread ideas that are relating to Austrian economics coming into mainstream newspapers and publications in the build-up to the crisis, i.e. before this crisis hit and people started scrambling around for new ideas to understand it. there was some evidence that Austrian economics is getting a hearing. This is in The Economist. Elsewhere, an economist at SBI Capital, the Austrian business cycle theory can be very well applied to explain the current global as well as domestic financial imbalances. The Financial Times, the Fed, with the encouragement and support of the political class, kept rate low so as to continually postpone financial busts over the past decade. The Austrian analysis is probably the best one on hand to analyse the present bind of investors and central bankers. And then the Bank of International Settlements, which some of you may be aware, has written a number of policy reports in the build-up to the credit crisis from a very distinctly Austrian perspective. They say financial liberalisation has increased the likelihood of boom-bust cycles of the Austrian sort. So again, there's this widespread understanding. These are all of the quotes that I can find, so I'm not saying that this is the majority view, but these are things that are in the press in the build-up to the financial crisis. The interesting thing here is that almost any media commentator implicitly relies on an Austrian theory of the trade cycle when they explain the financial crisis. Whenever anyone is talking about the culpability of interest rates being so low, excess savings in China, all of those monetary disturbances where the interest rate is being seen as a key mechanism is, whether they admit it or not, an Austrian theory of the trade cycle. The problem is, though, the Austrian explanations for the causes of the crisis, which are now fairly widespread, hasn't yet carried over into a fair hearing for an Austrian cure. And this is one of the most difficult things to understand about the financial crisis at the moment for somebody that does research in this area and also tries to contribute to the public debate. It's almost widely agreed now that Austrian has something to say about what caused the crisis, i.e. central banks keeping interest rates too low. But there's almost a complete unwillingness to talk about what the Austrian cure might be and what the actual implications of this are. A couple of examples to the contrary that I've noticed this month, mainly in the Financial Times. We start to see, obviously, Ron Paul in the US has got widespread public attention to his ideas about the problems related to the Federal Reserve. This kind of is starting to be seen in the UK press. So there was an article recently in the Financial Times talking about Ron Paul, so this is central banks in the context of the US. Also, October 23rd, so this was on Friday, Financial Times mentioning Mises, the Austrian economist. For von Mises, government is the danger and is never justified in interfering with the market. For followers of von Mises, the expansive monetary and fiscal policy that has followed this crisis is wrong. They would advocate a drastic paring back in regulation and the removal of discretion from central bankers. Now, this is far from the Financial Times advocating an Austrian position, but given what's happened in the crisis and the explanation that these journalists are having to rely on to explain the crisis, they're now forced to at least give these fairly radical Austrian ideas a hearing, whether to agree with them or not. My own efforts to put this in the mainstream press, this was something I had in Guardian Unlimited recently. The notion that the present financial system is laissez-faire is, of course, ludicrous. At present, we have a nationalised organisation that holds a state-granted monopoly on the issuance of currency. If this were any other industry than finance, the Bank of England would be seen as the Soviet-style planning board that it is. That generated a number of very interesting comments on Guardian Unlimited, so if you want to see what Guardian readers typically deal with that. But there was also a lot of interesting comments, right? So this wasn't just people that were kind of being completely confronted and putting up the drawbridge or whatnot. This actually generated some very interesting debates, and the whole purpose of this article was that this is the debate that we need to be having. We can't be taking things for granted. If you're looking, and this is kind of my slim pickings of Austrian ideas for the cure to the crisis being in the press in terms of the banking system. So this is a fairly kind of disappointing message, right? There isn't that much out there. One thing that, to give it a fair hearing, we could look at a bit more is this concept of narrow banking. So this is an important component of honest money, and there is some evidence that this is being seen more and more in the press. This was Martin Wolf on October 22nd. This is not to argue that there's no way of making finance safe. There is, but it would be far more radical. Deposits would be 100% reserve backed. The liabilities of other investment vehicles would be adjusted for the market value of their assets at all times. To him, this means banking would disappear. It's not at all obvious that this would mean that banking would disappear. But even now, the likes of Martin Wolf are discussing these very radical options. This is essentially a form of narrow banking, in other words, a system of banking where there's a separation of deposit taking and financial intermediation. This has been advocated by the likes of John Kay and Kevin James at the Bank of England. It's also received kind of just as kind of mainstream criticism from the likes of Martin Wolf and Willem Buiter. However, this is now in newspapers, and a month ago, 2 months ago, there was very little attention. Now, the main point about what I want to share with you today essentially comes down to public perceptions. For those of you that aren't necessarily familiar with the nuances of narrow banking and other forms of honest money, public perceptions of banking are crucial to these theories. Generally speaking, the public takes for granted that finance equals capitalism. This is why it's very difficult to generate a debate about the proper role of the Bank of England. It's almost assumed and taken for given that because the Bank of England deal with money, they are a capitalist organisation, as opposed to a state nationalised organisation. However, the general public's beliefs are very important. They are critical to an Austrian theory of the banking system. Indeed, much of the debate about honest money rests on an empirical assertion. An assertion about the degree to which the general public realise that commercial banks lend out demand deposits as loans. Broadly speaking, there are two branches of honest money. There are two schools of thought in the Austrian tradition when it comes to financial markets. The first is the 100% reserve view. This is most famous by the likes of Murray Rothbard and Huerta de Soto. This is where essentially the argument is that the evolution towards fractional reserve lending has been caused by fraud and legal plunder. In other words, banks are not honouring their commitments to make sure that people's deposits are available for them to return when they need them. The alternative view is what's known as free banking. This is more familiar with the likes of Larry White, George Selgin, Steve Horowitz. Free banking means that essentially the argument that they have is that banks aren't just responding to the demands of customers. They're responding to demands of customers for instant access money that has a positive rate of return. Now, what this debate comes down to, and we can see this in a couple of quotes, this was a very recent article by two people that are broadly sympathetic to a 100% reserve view. What they say is we assume that many depositors are not aware of the fact that the bank does not safeguard their deposits, but uses them. I put in a footnote here, which is almost tiny so that no one can read this. Elsewhere in the article, they kind of backtrack a little bit on this, but this is essentially the view of the 100% reserve crowd, is that depositors just aren't aware that banks take their money that's held on current account and then loan it out, make lots of money on it, and if you want to come and take it, then there's a possibility of there being a bank run. So the other side of the debate, the free banking view, they say we doubt that most depositors are as naive as Hoppe, who is a prominent advocate of 100% reserve requirements, believes. So we have here two sides of the debate, both making assumptions about what the general public believe. Are the general public aware that this is what banks do, that banks take the money that we give them as deposit and then lend it out so that it's not there if we all need to take it back at once? My claim is that these are empirical assertions, right, what the general public believes, and to my knowledge, no side of this argument has actually attempted to ask the general public what they believe. In other words, this is an empirical assertion. To some extent, it can be settled through a survey. Okay? So any claim about deception, about the intentions of depositors, and about whether or not banks are facilitating the intentions of depositors are essentially mute until we have these sorts of studies. So the bottom line for this talk now, what I want to share with you is the results of a study that has essentially been targeted at precisely this issue. This was a study that was conducted by ICM. It involved 2,000 people from across the UK. Questions were validated by a number of economists on both sides of the debate. I'm sure that all of those economists would say I suggested a tweaking of these questions. But obviously it's impossible to get economists to agree on anything, and agreeing on questions like this is even more difficult. So the proviso is that this is a survey that's supposed to start the debate as opposed to be any kind of definitive conclusion. The survey took place between the 7th and 9th of August 2009, so relatively recently. The only delay in showing this is just my general kind of academic laziness. So the first question was, why do you keep some of your money in a current account? right? This is what a lot of the argument is about, is whether or not people are using this as a form of safekeeping, and whether they put money into a current account, they expect it to be available for them at all times. So we asked people, why do you keep some of your money in a current account? And the answers were as follows. 15% of the people polled said that it was for safekeeping. 67% of the people polled said it was for convenient access. 10% because it earns interest. 6% claim that they don't keep money in a current account, which I find quite difficult to believe. 2% say they don't know, which I don't find difficult to believe. With all of these results, I'm hoping that both sides of the debate are going to be able to kind of pick on whichever, which parts they seem to kind of support their view. I've shown this to both sides of the debate, and they both think that this survey kind of definitively shows that they are correct. I'm just kind of presenting it there. I'll draw some kind of conclusions of my own, but I just want to present these results now for you all to have a look at. Question 2. Who do you think owns the money in your current account? I could have done this as a kind of quiz, and we could all have, done a little opinion poll in this room or something. 74%, so 3/4 believe the account holder. So if people ask who owns the money in your current account, 3/4 of the British public say we do, it's our money. 8% realise that in actual fact, from a legal perspective, the bank does, that the bank has legal control over that money. 16% think that there is this kind of pervasive dual title that both the bank and the account holder do. Again, we've got 2% who don't know. And again, this was 2,000 people, so I think this is a fairly substantial number of people that simply say, I don't know. 3/4 though wrongly think the account holder, that they are in ownership of their money in their bank account. Question 3, thinking about the money that banks hold on their customers' behalf via their current accounts, what percentage of that money do you think is A, held as reserves in their vaults to meet immediate withdrawals? And it would have been even harder to read if I didn't do it this way. The bottom line is 65% say, I don't know. 35% answered fairly evenly on a scale of kind of 0 to 100% what fraction of reserves they are. The reason why I'm showing this graphic is we also asked, okay, what proportion do you think is held in reserve? We also said, what proportion is held as reserves at the Bank of England? And we got a very similar answer. We also asked, what proportion is lent out as commercial loans? We got a very similar answer. We also asked, what proportion is used to speculate on financial derivatives? And we got another very similar answer. So the bottom line here is, if you ask any question to the general public about what is your bank doing with your money, 2/3 say, I don't know. I'm not sure that this is necessarily a bad problem, so I'm not presenting this as being necessarily a bad problem, right? It's not always a problem that we don't know what people are doing. This is probably one of the reasons why we use banks and other, especially people like this, so that we don't have to worry about what's happening to our money. But we might consider it a bit concerning. Question 4. There's only 5 questions, just so that you don't get too sucked in by this. Question 4. You may or may not have been previously aware, this is where we try to tally the two sides of the debate of the economists with ICM, who were trying to explain how to write a question that people would understand if they've got no prior knowledge about banking. So this is why this question is a bit long. You may not have been previously aware that banks lend out some of the money deposited within a current account by their customers to fund loans. Which of the following best describes how you feel about the fact that your bank lends out some of the money in your current account as loans? So this was relatively interesting. 33% said that this is wrong. I have not given them my permission to do so. So remember that 74% believe that they own that money. Only 33% are saying that this is wrong. I've not given them my permission. They should not be doing this. 61% say I do not mind as long as the bank pays interest and aren't too reckless. So this is a really interesting question now, because it gets into this fact about whether people are willing to accept a positive rate of interest in exchange for some risk about the possibility of a bank run coming and banks having difficulty paying back deposits. But there's very clear evidence here to say, look, almost a third of the public are saying this is what banks are doing. I was not aware that this is what they were doing, and I do not give my permission. I do not want them to be doing this. Question 5, I think this is the final one. Given that banks only keep a fraction of money that customers deposit with them in reserve, If more than 1 in 34 people wish to withdraw all of their money at the same time, they would not have enough to pay out. Which of the following apply to what you think about this? So for me, this is the real money question. In other words, what policies do you think should be in place? This is the result. The shared most common answer, 33%, so a third of the people asked, said the government should guarantee the money and intervene if there's a bank run. So this is essentially the status quo, right? This is the policy that we have at the moment. My surprise here is that only a third of the general public said that this is the optimal policy. Another third of the general public said banks should be subject to normal bankruptcy laws so that they act more cautiously but can still offer an interest on current accounts. So my surprise was that such a large proportion of the public were under the impression that if banks were subjected to normal bankruptcy law, then this would mean that they would be less likely to have a bank run in the first place. 26%, so still over a quarter, this is still, in absolute terms, a large number, say we should ensure that banks keep reserves equal to 100% of deposits. So the bottom line here is that there's actually a quarter of the British public advocating and supporting mandated reserves, 100% reserve requirement on UK current accounts. Okay, so hopefully this has generated a bit of interest, so we're going to go into Q&A. I just want to give you my kind of results or the summary that I put to this. Firstly, people do not primarily put their money in their current account for safekeeping, then use it primarily as a source of liquidity. So one thing you'll find in the debate on honest money is whether or not banks exist for safekeeping. Personally, I think that now is an anachronism, and people don't view their current accounts in this way. 74% of the public incorrectly believe that they own the money in their current account. So obviously this is a real standout figure. Around 66% answered I don't know when asked to estimate what proportion of their current account is put to various uses. So again, there's strong evidence here that people aren't generally aware of what banks are doing with their money that's held on deposit. 61% do not mind that banks lend out reserves, but 33% think that this is wrong. There's a difference of opinion here whether or not, for some economists, if one person thinks it's wrong, then the law needs to kind of change to reflect this. To other economists, as long as there's one person that doesn't mind it, then it should be allowed to happen. So this is obviously providing evidence for both sides. And then finally, 26% are in favour of 100% reserves, whilst 33% support government-backed guarantees, and 33% believe that the threat of bankruptcy is sufficient. So just to conclude, the bottom line here throughout all of this is, whilst we're focusing on the actual prospects of honest money, let's not lose sight on the status quo, which is far from honest money. The conclusion here that both sides of this Austrian debate agree on is that it's the nationalisation and the politicised management of the currency that cause monetary disturbances, not markets. This is the bottom line that everyone seems to acknowledge is a crucial cause of the credit crisis. So far, people haven't carried this over and said, well, if the Bank of England have caused this mess, then do we really trust them to clear it up? And do we trust them to exist anyway, to just go and create another one? But this is where the debate needs to shift, right? Away from monetary policy and towards monetary regimes. Narrow banking is a type of possible solution, not necessarily the solution. So one of the issues here is that it's up for academics in terms of the division of labour. It's for academics to provide the guidelines of what would constitute sound money. It's up for entrepreneurs to actually execute those plans. So whether narrow banking is one option or another, this is something that hopefully entrepreneurs would be able to come up with, and we can see whether or not this is what people on the market would choose. My main conclusion is that fractional reserve money funds are in principle fine. This is going kind of off tangent a little bit, but generally speaking, when you look through most of the work that's being done now by both sides of this honest money debate, they don't really offer a dual title. Depending on the wording of the contract of a fractional reserve money fund, they don't necessarily have to offer a dual title. They don't necessarily violate an obligation to safekeep deposits if it's not contractually specified to safekeep deposits. I don't think there's sufficient evidence to say that people can genuinely expect this to happen unless it's specified clearly. And also they aren't the primary cause of credit-fueled trade cycles. That is the nationalisation and politicised management. However, the problems with fractional reserve money funds are that in order to have a fractional reserve money fund that isn't creating a boom-bust cycle, there needs to be limits on over-issuance, i.e. there needs to be some mechanisms in place that prevent free banks from issuing infinite amounts of currency. Ordinarily, free bankers will point to the threat of redemption. In other words, if any given bank over-issues, then because people are going to immediately redeem those banknotes, that bank will soon go out of business, and they use a competitive framework to explain why we won't have over-issuance. There's actually another constraint on over-issuance that most free bankers tend to ignore, and this is very basic auditing requirements. So providing banks are subject to similar auditing requirements to other businesses, in other words, legally they are unable to go into a period of insolvency, legally they are unable to mismatch maturities and to present that as being a sound business, then this is another limit on over-issuance. Those are kind of generally the conclusions that I think that survey take in, but that's the main thing that I wanted to share with you, these results of this survey. This will be published through the Cobden Centre, so I encourage you all to keep a lookout for that when it does, and hope that you can kind of propagate that and do what you can to get this into the mainstream a bit more. Because what we are facing now is a constitutional moment. We have a financial crisis. This is an opportunity. At the moment, as I went over at the beginning, these real policy ideas aren't making it into the mainstream newspapers. The general public are largely ignorant of these debates. So we couldn't have asked for better times to try and get these ideas across. And at the moment, collectively, we're not doing a good enough job doing this. But what I'm hoping to share with you now is some ways of making that change in the future. Okay, I'm willing to go now. Let's have as much Q&A as possible.
Thank you very much. We'll give Dr. Evans the second round of applause, so it's good to have the first one. So, in any order, this gentleman here.
Thank you. I share the view that central banks are responsible for dislocating the economy. Before the recent financial crash, the central bank said there's too much liquidity slopping around in the economy, let's put up interest rates to mop it up. And they did a very good job at doing that. In fact, they exceeded their objective, and that is partly the cause of the insolvencies and the inability to meet mortgage payments and so on. I just want to make a comment.
I mean, I think you can see if you take a standard Austrian cycle, I think you can see it match, almost perfect. Even that spike, and especially this kind of spike in inflation interest rates, when people realise that there's not as many real resources in the economy as they thought there were. So everybody's out lending, and then all of a sudden people turn around and say, hang on a minute, there actually isn't enough activity to support the lending that we're doing. And that's when you have to scramble for funds and you have a little spike in interest rates. And you can tell a very convincing story. You can take any pamphlet on Austrian investment, written in the 60s, 70s, 80s, and you can view what we've been seeing through that now.
I'm just saying the bank artificially put up.
But you would also see one of the things, you would also see a kind of a natural increase in the rate of interest once people start scrambling for funds. That's exactly what we saw. But then certainly all of that manipulation on top of that is actually making things worse.
Boehm-bawerk.
Thank you.
Excellent talk. By the way, I should point out a bit of self-advertisement. I write for the group website, samisdata.net, under the pen name Jonathan Pierce.
Okay.
And I've linked some of your stuff, and I'll continue to do so. As that's funny enough, the other day I actually quoted an article out of a book by Thomas Woods called Meltdown, which I'm sure you've read. It's a really good book. It's actually one of the best and tightest explanations from an Austrian perspective of the mess we're in and how to get out of it that I've read for years. I recommend that book to anybody. Just one quick point is, are you thinking about surveying people about the idea of getting rid of legal tender laws? Because if you think about it, getting rid of legal tender laws flips over Gresham's law. Instead of the bad money driving out the good, the good money drives out the bad. In other words, if you don't have to accept a pound note because you don't trust it, because you think it's worthless, you only want to be paid in gold or whatever, then you can. And it would be really interesting to ask all the members of the public in a poll, what do you think about that? And I would strongly suggest the next time you've got the energy to do another poll that you ask them that, because most people just assume, they just take it with their mother's milk, that if you live in a particular jurisdiction, you have one currency. The euro or the pound or the ringgit or whatever it happens to be. And I think it really would be good to challenge people's minds, saying, actually, have you ever thought it might be a great idea if you could actually choose your currency?
I think Hayek identified that as being the kind of the crucial piece of legislation that would, you know, if you had to choose one thing that you could tip, then that would be it. And certainly I think that's the crucial thing as legal tender. I don't know how to, and some of these results, I'm not sure how to interpret them, given that I'm not convinced that the public, you know, really understand the implications of what they're answering to those. So certainly, whilst that would be a kind of a crucial policy reform that we should all be kind of trying to get around. I think that it could have widespread support. So the way that I view it is almost there's a lot of public backlash to the imposition of measurement systems that they don't think are organic. Metrication, for example. If you can bill, you know, sterling as metrication and say, you know, why should we necessarily have one imposed measurement system, you know, whether it's for greengrocers or whether it's, you know, in terms of the scales that the greengrocers use and also the currencies that the greengrocers use, why can't they similarly choose whichever scale they wish to use or something? I think that it could be sold in I think there's ways in which you could get a hook into that. I have no idea about how it would sound at the moment. My honest kind of opinion is that anything to do with money is seen to be free market, almost like, and that's just taken as given. So it's very difficult to kind of first shift to say, you know, we're starting off from a position here of statism. But no, I agree completely. The legal tender laws is basically, if we can get rid of that, then, you know, then we're cooking.
It would be interesting to have the same poll taken in other countries and compare with the opinion in this country. Gentleman here, and then Antoine Clark. Yeah, gentleman here. Yeah.
Christopher Venus.
Yeah, sorry.
Actually, the nub of my question was very well anticipated just now, but I was going to ask how quickly and how likely do you think it is that the public would wise up, shall we say, to the merits or otherwise of fractional reserve banking versus narrow banking, given the reality that there would be quoted exchange rates by institutions between these various three currencies?
I think that's tough, right? That's the downside, is that people would say, well, you know, I like the euro because it makes my shopping a bit easier when I go on holiday, and then you try and point out that some of the costs of that, as with any sensible economic policy, the costs are fairly apparent and obvious, and the benefits are diffused and less obvious, and that's why we live in the world that we live in, because basic economics is counterintuitive for the unseen and the seen. So I think, you know, that's what we're always going to be coming up against.
Antoine. No, Antoine Clark. Sorry. Over there.
Thank you. I was very interested with your figures, and they tie into something that I thought a lot about, which is that there's a great deal more common sense in the public than ever appears in television programs where a selected audience turns up like Question Time. I think that the more you ask the public anonymously what they think about the situation, the more likely they are to recognise insanity when it exists and to recognise some kind of a common sense solution when it exists. It's one of the reasons why I'm a great optimist, because in the long run this does break through in some way, or at least mitigates the insanity that gets imposed. And one thing that occurs to me, we've got people from the LP UK here, but I would have thought all the political parties would be interested in this type of figures, because sometimes the problem is that the politicians have a vague idea of what the solution involves, but they assume that the public will never buy it. Well, what that tells us is that the public is a lot more ready for some of the solutions that we would advocate than the politicians' dream is true. I would imagine they assume it's 90% support government intervention to prop up bank balances, and yet very clearly that isn't the case.
So Nick Cohen and then Tony Brown. Nick Cohen.
Well, I'm sorry to ask sort of the old big question again, but I suppose both Keynesians and Friedmanites, to a greater or lesser extent, would sort of, while agreeing perhaps with the efficient cause of the current crisis, would also say that there are other causes of trade cycles in the absence of central banking. And a lot of their arguments are quite plausible, in that they might say, well, look, you might get some irrational exuberance, some overinvestment in some areas. That's regardless of your banking system. And you can go back and you might argue that the crises that happened before are nowhere near as bad as the Great Depression, but at the same time, at the time, they were pretty damn scary and had caused many problems as well. I mean, I suppose, is there an answer to that problem other than the fact that in the end, you get slightly less bad results in the absence of any intervention whatsoever? I mean, is there a sort of negative response, or is there a more positive account of I suppose, avoiding trade cycles in the absence of central banking?
I think that, I mean, that is difficult, because the alternative isn't peace and happiness and everyone lives happily ever after, and that we don't have any cycles, I think. The key point is explaining the way in which central bank amplify cycles as opposed to necessarily create them. Right, so rather than if you've been very kind of clear with your language, I wouldn't want to say central banks cause crises. It's more of a case of they amplify cycles and they send them off in the wrong direction. So I think the evidence is very clear that Keynesian style, tweaking the cycle, aggregate demand management that is essentially funded through inflation doesn't work and makes things worse. If those Keynesians and monetarists can come up with another type of policy ideal that as yet I'm not familiar with, that can say, okay, we can take these existing natural cycles and smooth them out of it, then we'll look at that as and when it presents itself. But it doesn't exist. And then at the end of the day, I think a free banking system is able to smooth cycles. There are kind of mechanisms within a free banking system. There's the flexibility of no issues and everything. That can do that. This is the really interesting difference between the Rothbardians and the kind of I guess the GMU economists. That's where the distinction is. Because if you do have a period of monetary deflation, do you just say we're going to go through a period of monetary deflation and it's going to taste bad, but that's what we have to do? Free banking does have in its own kind of in its locker room the possibility that you don't necessarily have a declining money supply when you're going through a crisis, as things stand now. So I think there are a couple of things that you can say. It's not just leaving, there are mechanisms in place which can smooth these cycles from a free market perspective. But then the bottom line is the whole kind of debate about smoothing cycles. What I do with my students is that I have a photograph of a I don't even know what they call it, when you're in hospital and you have your heartbeat, right? And I say, okay, at point T where this flat lines, is this a sign of successful healthcare or something else? Right? And the point is you don't want to be going up and down but then if you take away this amplification effect by central banking, then I don't think you do. But it's healthy to have cycles, right? This is part of the system. We don't want a flatlining economy.
Two quick questions. In your question about who owned the money in the current account, did nobody suggest that it was owned either by the government or the Bank of England, or did you actually set out the alternatives so they had to choose between the two? Right, yeah, so these answers were pre-specified. So it was a multiple choice survey, and the answers on this pie chart were the only options available to answer. So actually, some people, if you hadn't prompted them, might have answered that the money was owned by the government or the Bank of England. Correct, yeah. And the second question, purely technical, I thought that at least in a technical sense, one of the differences between the UK and our EU partners was that we don't have an official currency in quite the way they do. And whereas a German business has to accept payment in the form of the Deutschmark and then the euro, in this country, in fact, the business can accept payment in whatever form it likes. It merely conventionally chooses sterling, though some businesses occasionally choose other currencies, such as the euro or the dollar. I'm not sure. I wasn't aware of that. So if that's the case, and there's no there's no law to say that businesses have to accept payment in pounds, and that we could create a shadow currency, and people, if they wanted to, could start all trading euros. I wasn't aware of that. That was certainly my understanding. I may be wrong. It may be somebody else in the audience
knows, but it is the reason why, for instance,
Antoine, do you know the answer?
I know the answer to that.
Okay.
The answer to that is that you have to take sterling, but you can take another currency. So Marks and Spencer does this occasionally. You see signs up saying we take euros, we take dollars. Shops can take other currencies if they wish. What they cannot do is exclude.
They can't refuse it.
Yeah. Well, that's the same in Europe then. That is the same in Europe, and that is in the Eurozone, and so on. Ben, and I think we'll close there. Who else is... Oh, you, sorry.
Yeah, can I ask a question first? Actually, being holding the microphone for a while now.
Yeah, I was seeing you waving.
Yeah,
I could not understand.
I was trying to ask a question anyway. So,
Okay.
Ms. Evans, I'm quite interested to hear what you think the government is going to do with these so-called bail banks. Because from my perspective, first of all, the government didn't want to make any money from it. Because if we look at the back of end of August or beginning of September, if the government wanted it, they will at least make £13 billion from the bail bank. They just sell their share estates or do whatever it takes to get this money. But actually they didn't. So I don't know what's wrong with that. Second of all, the government didn't really want to save the market. Because back in March, if you say the government bailed this bank out, yes, that was literally going to save the market. But now, well, the whole government intervention is actually the distortion of the efficient market. As not mentioned, if they say they are going to get rid of the stake of in RBS or HBOS, or Lloyd's TSB. So actually it's showing the government to have the confidence in the economy, but actually the government didn't do that. So that's the second my thought. Third thought is, of course, the government don't want to give these corporate executives any good days at all. It's like, actually I think the government is penalizing both RBL and TSB, Lloyd's TSB people. So I was wondering, what do you think the government is going to do with this?
Well, the whole point is I don't know, right? No one knows. That's the whole. I mean, the crisis is as much down to regime uncertainty as it is about any monetary issues. The point is we're all waiting to see what the government's going to do, and we don't know what they're going to do.
So you have no source of data at all?
I've got no idea.
Okay.
No idea at all.
Never mind.
And if ever I woke up one day and thought I was thinking in the same way as a politician, I'd probably shoot myself. So I wouldn't even want to be in a position where I could predict what they're thinking.
You will run, but politicians think like you. So then you
Okay, that'll be acceptable. That'll be acceptable.
Ben.
Briefly, on legal tender issues, can you explain a little bit what I have a dim memory of, which was somewhere between John Major and Nigel Lawson, there was advocacy of the hard euro as a competing currency with sterling. It's a terribly dim memory, and I'm sure you know it far better than I ever could. It was a while ago, of course. Secondly, in refuting what you regard as a false belief that bank customers think they own their bank deposit currency, your evidence was simply that the banks have control over it. Now, disputes over entitlement are customarily resolved, or at least resolvable, through the courts. Can you dilate on your quick answer a little bit?
My understanding is that when that has been through the courts have found that the banks own the money and they treat it as a loan. So that, I think that's Carr versus Carr, 1811, I think, and Foley, 1873 or something. I think there are a couple of key kind of court cases where essentially depositors have done that. They've said, you know, deposit money, where's it gone or something, and the courts found essentially that these were loans. The demand deposits, the current accounts, from a legal perspective, they were loans to the bank. The issue is whether or not people are aware that they are loaning their money to the banks and they don't own them. What this finds is that they're not aware of that, but they don't seem to be too fussed about it.
Well, this puts an end to 2 days of absolutely thrilling talks and intellectual stimulation and enjoyment. The bar is open for more socializing and...
That's what you were saying. I thought they were all staying for my talk. Okay, now I understand.
And discussions and so on. I would like you to give a thunderous applause and make a lot of noise to our speaker, Dr. Evans, but also to the organizers of this wonderful conference, Tim Evans, Sean Gabb, the microphone operators, and all the people who have contributed to
Ladies and gentlemen, before you go off to the smoking room, which is actually non-smoking, before you go off to the smoking room for your drinks and nibbles, I'd like to draw your attention to the white envelopes, which are a free gift from us to you. But if you have any loose change, banknotes, the sort of money that you regard as
dishonest money,
useless money that will mess up the line of your clothes and so on.
You take euros.
I do invite you. Euros. I do invite you to put that useless money into the white envelopes provided and give it to us. There is a serious point to this. We have, whatever the authorities say, there has been an inflation during the past few years, and our costs have suffered in that general inflation, and yet for the third or fourth year running we haven't put up the price of the conference. And so if you do feel inclined after 2 days of intellectual and physical overindulgence to reward us with a trifling gift of cash, we should be very grateful to receive it. Other than that, I want to thank all of you, not just the speakers, but you as an audience for having been so receptive of the past few days. Thank you. I was glad to see you last year, I'm delighted to see you this year, and I shall be just as happy to see you all again next year. So thank you, ladies and gentlemen, and you know where the drinks are.